How long do you think it can last?
There's a lot of cuts in trucking coming. The labor market's softening up. I just think the case for accelerating inflation is over.
Here at FS Insight, we provide individual investors access to research previously only available to banks and hedge funds. Our top-tier research team provides multiple financial outlooks, including macro, technical, quantitative, and more. With access to multiple stock lists and daily market insights, now you can finally invest on a level playing field.
Fundstrat Global Advisors Managing Director Mark Newton, one of the best technicians in the business.
I think it proves short-lived. We likely hold 4,000 rebounds in the second half of the year, so I stand by that. I think we all know that supply is never going to be able to meet demand truly, so warmly welcome you to our FS Insight Technical Analysis webinar. This is your time. Hello, everybody, and welcome. Thank you for turning out today. My name, of course, is Mark Newton. I'm the head of technical strategy at FS Insight. Thank you, as always, for your support and your interest in my work and technical strategy in general. Today, of course, is your time. So we're going to be discussing the stocks that mean the most to you. And for those that are new to this kind of thing, we do these about once every month, once every other month. And you can go to fsinsight.com, technical strategy, and vote your selection. So those are the stocks that you care about the most, and I'll be running through those and giving you my insight. So without further ado, thank you, and let's get right to it. I'll be sharing my screen. I'm going to be using TradingView for this particular segment, as I've done before. I typically use a combination of a bunch of different softwares, and so this just happens to be one that makes it quick and easy to run through big lists and run through them. And so, this is what we're going to be using. So let's talk about the S&P for a little bit. And for those that are aware, I am expecting a low in the market, really right. It could be, over the next couple of days. It could be early next week, but I think we're very, very close. And my level was 39.25, which was a hit on futures this morning. It was, we got to 39.28 in S&P cash, of course. And I want to discuss a little bit more about how I came up with those. I've had several questions on Twitter and questions that have come into our email. For those that are new to this type of thing, if you go to inquiry@fsinsight.com and submit questions, and, they'll round those up, and occasionally I can get to those when I have time. But this area is interesting because not only is it a Fibonacci retracement of the whole move up since October, and I think that's interesting, but also it's a Fibonacci retracement of the move up since late December. So it's 0.618 or 61.8% of the move from really December the 22nd up to the February the 2nd. And it's really a 38.2% retracement of this. If you actually use Gann analysis based on the square of 9, this area also lines up exactly with this prior peak from back on February the 2nd. So there's a number of different reasons why I thought this could have importance in general as providing some support. I can't yet, as of now, say that we definitely have put in a low just based on a small reversal. We are making a fairly nice pattern today, a bullish engulfing pattern on S&P, on many of the different indices. This does fit in with the time frame in which we can reverse. As many recall, the 60-year has worked for probably the last 15 months, and almost every ebb and flow of the market has really dovetailed what we see in 1962 for last year, this year 1963. This year hasn't been a direct hit, but thus far we've seen weakness throughout the back half of February that does bottom in early March in 1963, which 60 years later, of course, is this year. So we shall see. I think that March is heading to be a much better month than last month. And the fact that sentiment has turned so negative, we really have not done substantial damage in the indices. And uptrends are very much intact if you look at it on an equal-weighted basis. And certainly some great strength out of technology, which outperformed all other sectors last month, even though all were down. Tech was up more than 200 basis points above the S&P last month. I think that's very interesting. So in general, I think it is right to be bullish. I think that it is right to buy dips, and this does look to be an important point. You know, we had about a 42-day rally from December the 22nd to February 2nd, and so this is about a 61.8% fib retracement in time as well as price, both lining up right at this area. And, you know, oftentimes that can be important. I want to really take the length of the entire move up since October. Measuring that gets us to mid-March, March 15th, March 16th. So I also think that can have importance as well as the final day of March in terms of turning points for this month. But without further ado, we see that, you know, momentum and trends are certainly still bearish. And there is a little bit of stabilization, of course, in the last week. What's the level we need to get above to think that we're in the clear? Well, that'd be 40.60. So getting up above 40.60 means that we're not only going to start to rally up to test, but likely take out these highs and get up to really levels that we're seeing last August. I have said before, and I'll say again, I think the October lows are going to stand for now. I think that this year is going to be a bullish year. It's not saying that we can't eventually retest those in the years to come, but I think that this year and next year both look much better from a cyclical perspective, and a lot of the sentiment directly ties into that. So intermediate-term sentiment was clearly bearish. Short-term sentiment got a little bit giddy in the beginning of February. Now that has retreated, and now we're looking at bearish sentiment again. You know, at least very much neutral based on things like fear and greed and some of the option flows. I think AII now shows a 20 percentage point spread between bulls and bears. So I'm happy to cover this in more detail. Of course, in my notes, I really want to get into what you're looking at, and we'll just start with QQQ. You know, first of all, I want to discuss a little bit about the phenomenon of the 200-day moving average, because I really don't give that much credibility in my work for really causing any sort of meaningful turning points in the market. I know it does occasionally work. It did work great back in August. It can be very choppy. Like those that tried to sell into this, obviously we went through it by a small amount, then we went back through it, then we went up through it again, then we went back. This time around, obviously into January it didn't work, and now it did. But when you go back over the years, you find that, you know, going back to 2018, you know, it proved to be very, very erratic and really did not give us hardly any signals. This is, of course, was 2020 when we sliced through it. That was a negative, but there was a sideways moving, moving average. But other times it's been very difficult to utilize that with any degree of success as to why that might actually work. And many times we see that, you know, it provided to be an exact opposite of what we've seen. I mean, at this time, of course, back in 2015, for example, we went through it, we went above it, that was bullish, right? But then we went through it, that's bearish. It's been very, very tricky. Even this time when we crossed back through it in 2016, we broke it. We went back up through, it did hold a couple times, but in general, it's been very, very inconsistent in my view. QQQ, though, something that's held up relatively well, I think, and looking just at the current technical pattern, we see that prices as of now, we've pulled back and we look to be holding, of course, the 200-day on a close, but we need to see more movement right back up above levels near 297. That would be the same level that coincides with the S&P 40/60. That would be a very good signal and suggest that we can start to really push up above this level and get up towards 330, 335. Can't rule out maybe a final pullback, and a lot of that has to do with just what's happening with yields. Yields, of course, did break out. The 30-year today broke 4% on the upside. So that joins the 10s, the 5s, the 2s, all being above 2% or 4%. There's no immediate sell signal for yields when looking at things like DeMark exhaustion on the 30s, on the 10s. This is something that's really critical because you see we actually bottomed in yields on February the 2nd. That's when equities peaked. We had peaked in yields back on the 13th of October. About a week later, that's when equities bottomed. Equities bottomed about a week ahead of this, but yields were close to peaking exactly when equities bottomed. So this relationship is still very much intact. In this case, it's a negative correlation between yields and stocks. I think the maximum upside is going to prove to be really 425 to 435 in the 10-year. I do think there's a possibility that the 30-year gets to 420, but I don't see much further upside in yields, and then we should start to roll over, which will coincide with a lot of the cycles. Let's talk about Nvidia a little bit. Nvidia remains a very strong stock in the near term. It's really come back with a vengeance. This stock had been a laggard for some time, but you note the technical structure really started to improve dramatically when we saw this little breakout back in the early part of January. A lot of stocks broke more than a one-year downtrend at that time, and then we started to see real acceleration. So momentum has gotten a little stretched in the near term, and we started to roll over, but it's still an attractive stock. I think Nvidia gets to 245, 250. The one thing I would note is that when looking at this based on a few other tools, we are very close to seeing TD sell setups based on Nvidia. So this probably would not be my first choice for a stock that I think in the near term can continue moving in the months to come. One really wants to look at, some of the semiconductor stocks that are just starting to come to life and that are a little bit better in that regard than Nvidia. But I love the structure. I love the overall trend and the momentum. It's just that, as you can see now, we're having a little bit of negative momentum divergence. And even on this little breakout we saw last week, momentum is actually lower. So my thinking is we are going to see a push up to 245, 250, and it's going to stall out and will probably give us a pullback to really want to buy into that. Really anything under this level near 206 is a little bit of a problem for the bulls. That does mean that we can sell off and likely test this area near 187. As always, making use of trend lines, the low to the low that precedes the highest high is the proper way to draw these. And so, this area near 204 is going to be really important, right near the lows from February the 22nd. Below that, of course, is at 187.90. So I'm bullish, but upside to me, I'd rather use strength to really sell into Nvidia and wait for consolidation versus sticking with it personally. Tesla, let's talk about this a little bit. I had discussed reasons why this could break down and fall in half, and that was back last October, November, and I went on CNBC and discussed that right as this was breaking out of this massive head and shoulders formation. This got cut in half, and literally it peaked. It bottomed right near $100, $105, and literally has doubled since that time. I would just note that, in general, the cycles I use are still negative on Tesla between now and May. I would also note that this has rallied right back to test the area that it broke down from and got overbought after a doubling in price. And now we're seeing today break down to the lowest level we've seen in weeks. So I don't like Tesla here. That'd be one stock that I would actually avoid in the short term. It is still part of my laggards on the Upticks. For those that know, I put together a list of my favorite longs, and I have a few stocks that I think should underperform, and Tesla was one of those. It's not a trading portfolio, so I don't update it every day, every week, but normally it's once a month. So this still remains on that list as a laggard. I do think we're going to see some pullback in that. Today looks to be a technical break, and Investor Day, obviously, we heard some reports as to, I didn't read the specifics to the detail, but I think they are not going to use as many chips as they thought or something. And so in general, it is a bearish break. I do expect to see weakness in the stock in the months to come. What would change that is really a move back up above these prior, if we get up above, let's say 217 and really regain this area, this is sort of a tricky area for the stock where it really has a lot of overhead supply, which is really 220 to 240. So, I'm not fond of buying stocks that have doubled, that retrace right back to an area where they broke down from as a general principle. So I love the company. I love Musk's vision. I think that one should stand aside. There's plenty of better stocks out there right now for my nickel. Let's take a look at Apple for a little bit, because we have seen, a little bit of sign of pulling back in this after our breakout that we also saw back in the middle part of January. You saw Apple broke out, of course, back on January 23rd, 24th of this large downtrend, very good acceleration. Now we've pulled back in what appears to be a little bit of an ABC type pattern. I do like buying Apple. I think that this is going to be fine. I think it's one of my favorites of the FANG stocks, even though, traditionally it wasn't part of the FANG group. But I think that, anywhere between 141 and 144, the stock bottoms, and we should start to turn higher yet again. Anything above recent highs is going to really propel this up to eventually retest the peaks from last August. So Apple is a long in my list within technology. I do like this stock quite a bit and would use weakness to buy. Amazon, a little bit of a laggard, not nearly as strong as Apple. We note that this did break down to new, yearly lows. It still remains challenging. Drawing up downtrend lines to connect former peaks really helped to nail exactly where the stock peaked out. And then recently, we saw the weakness as it started to break yet again. Tested, failed. Now it's pulling back. I don't mind buying this if I think the market's going to bottom out, but there are obviously better stocks within technology, even within the so-called FANG space. I think Microsoft is a better option, as is Apple, than buying Amazon or Google for that matter. But great company. If the stock can really start to stabilize here, if it can get back above prior lows near 96 and a quarter, that would really help to drive some enthusiasm in this name that it could really start to work. But for now, it's still trending down pretty sharply, even though it's up off its lows today. We need to see more to suggest the stock has bottomed. Let's talk about Palo Alto for a little bit. Great structure on a short-term basis. Yes, it has gotten overbought. You put this in a perspective of how it's done overall, you see that it traded in a very choppy, what I consider to be sort of a three-wave large decline from the highs. So that means that the stock likely is going to rally back to new all-time high territory. This shouldn't be the start of a major decline, particularly given its progress. It could be some resistance right here near 193. Above that, I think it's going to 211. And until it shows evidence of really breaking this uptrend, very strong name. And really any sort of pullback you see here, if we were to pull back to try to fill the gap a little bit, I don't think we'd actually get down under 176 in the near term. So I do like this stock, and I would own it. Microsoft, as I mentioned, I just added to my Upticks list in my most recent February update because I just like the way that the stock did break its downtrend from last year and has pulled back for 2 weeks now, right to the area where it broke out. And very strong weekly momentum. That's always a good sign. So I like Microsoft here. I would own it at 250. I think we're going to rally up to challenge 276 and get of it, and likely hit 289. That would be the highs from last August.